The S&P hitting a new all-time high on the heels.
Have you ever heard of the quote, "Time in the market beats timing the market"? It's one of the most repeated phrases in investing. But is it actually true? And what does it really mean? Today, we're breaking down one of the most common investing debates: dollar cost averaging versus lump sum investing. Which one is really better? If you had $10,000 to invest right now, should you slowly ease it into the market or go all in from day one? Let me show you two real investment charts. One is someone who invested slowly over time, bit by bit, while the other, well, they invested everything all at once, on day one. Now, just by looking at these charts, which one do you think made more money? If you guessed this one, you'd actually be wrong. Even though it looks smoother and feels safer, the investor in this scenario ended up with significantly less money. Let's talk about why. Hey, I'm Dave, and welcome to DocuWealth. On this channel, we break down money, investing, and financial strategy in a way that's fun, simple, and actually useful. If you want to build real wealth and better understand how money works, make sure you hit that subscribe button for more useful content like this. Alright, let's dive in. So, what exactly are these two strategies? Dollar cost averaging, or DCA, means spreading your investment over a period of time. Maybe you invest $500 every month for 10 months, for example, instead of $5,000 all at once. You're gradually entering the market, buying at different prices, good or bad. Lump sum investing is actually what it sounds like, taking a lump sum of cash and putting it all in the market right away. No waiting, no second guessing, just full send. DCA is popular because it helps manage risk and emotions. You don't have to worry as much about market timing, you're smoothing out your entry. Lump sum gets your money working immediately. It doesn't sit in cash, it doesn't wait on the sidelines. And over time, that can lead to real compounding gains. So which one performs better and why? Here's the part most people don't expect. Historically, lump sum outperforms dollar cost averaging about 2/3 of the time. Why? Because the market generally tends to go up over time. It doesn't go up every day or even every year, but in the long term, it trends upwards. So the longer your money is in the market, the more time it has to grow. If you dollar cost average slowly over 12 months, that means a big portion of your money is just sitting in cash on the sidelines, not working for you. And that means you're missing out on valuable returns, which can really add up over time. And this isn't just theoretical. Studies from firms like Vanguard and Morningstar have shown that lump sum investing usually delivers better results over 10, 20, even 30-year periods, even if you invest right before a crash. But here's the nuance. Just because it works better on paper doesn't mean it works better for everyone. Let's talk psychology for a moment, because this is where things get real. Imagine investing $10,000 today and seeing it drop to $7,000 next week. It happens. And if you've never been through that before, it can be brutal. It messes with your head, makes you doubt your decision, and can even lead to panic selling, which is where people really lose money. Dollar cost averaging smooths out that experience. Instead of putting everything in before a dip, you spread it out. That can help you sleep better at night. And if it helps you stay consistent, that alone makes it powerful. Consistency beats perfection investing, every single time. So, if you're someone who tends to panic or who constantly second guesses your timing, dollar cost averaging might be the better fit, even if it's not the mathematically optimal one. But let's bring it back to you. When does it actually make sense to use each approach? If you're investing money from your paycheck every 2 weeks, that's already dollar cost averaging. It's automatic, and honestly, it's one of the best habits you can build. It keeps you consistent and takes emotion out of the process. But if you come into a lump sum, maybe a work bonus, a tax refund, inheritance, or a big freelance check, now you've got a decision to make. If you're investing for 5+ years and you feel good about the market and your choices, then statistically, you're probably just better off putting it in the market. Even if it feels risky, history shows it's usually the smarter play. On the other hand, if you're anxious about the market or unsure where to put money, there's absolutely nothing wrong with going in gradually over time. Maybe you spread it out over 3, 6, or 12 months. It gives you a sense of control, and you're still making progress. What you don't want to do, sit in indecision for 6 months and do nothing. That's where real opportunity costs start stacking up. What is my personal strategy, you might ask? Well, personally, I do both. I dollar cost average every month into core positions like VOO or QQQ. I do it automatically, no emotions involved. It's consistent, boring, but effective. But when I have extra cash from a side hustle or a big month at work, and I know that I want to buy, I'll throw it in the market lump sum. I don't try to time the perfect dip. I just get in, because I know that my time horizon is long enough to absorb the ups and downs. Sometimes, if things feel crazy overvalued, I'll put the money in gradually, maybe split it up over 3 months or 6 months. But the key is this: I always make a plan and I always act on it. You don't have to pick one side forever. It's not DCA versus lump sum. It's about using both depending on the situation. So, what do you think? Would you rather go all in right now and let your money work? Or would you rather pace yourself and smooth out the ride? Let me know in the comments. Are you team DCA or team lump sum? And if this video helped you feel more confident with your money, do me a favor and hit the like button. Subscribe if you want more simple, honest finance content without the fluff.